Hi, in this video we are going to learn some basics relating to process costing. Process costing is a costing technique which tries to allocate the total manufacturing cost to each output unit. Now, process costing is used in processes which follow mass production or continuous production. Why? Because in continuous production, the output is massive, the output is identical. So, using process costing, the cost for each of these identical unit is ascertained. On contrary to process costing, we have job costing. Job costing is also a costing technique which is used for any custom made orders or any custom made processes involved or production involved where the output is unique in nature. The best example that differentiate job costing versus process costing is if you buy a piece of garment or piece of clothing off rack in a shop versus you giving that order to a tailor. So if you give the order to a tailor based on your design, based on your material choice, the order will incur certain costs. Now that cost will be different to a different order that the tailor has received. Another person would have provided a different design, a different choice of material. But if it's bulk production, mass production, like off-rack garments, the same material print is used, same quantity of material is used. So the products are identical. So in such a situation, process costing is the correct costing technique that needs to be used to ascertain, to calculate the cost of each of such identical output unit. So the heart of process costing lies in this process accounting or process accounts. Process account is very much similar to a T account. Onto the left hand side of the account, you have the input. Onto the right hand side of the account, you would denote the output. Now, what's difference between a process account and a T account is that in addition to an amount column, you would also see a unit column on either side. So just like how you have to balance a T account, in process account also you have to balance either side of the account. That means you have to ensure that the unit column on both sides equal each other and also the amount column of either sides match each other. So a usual process would have several processes like shown in this diagram. It will have process 1, process 2, process 3. Each of the process will be denoted by one particular process account. So process 1 will have one dedicated process 1 account for that. Process 2 will have a dedicated process 2 account. Process 3 will have a dedicated process 3 account. Another thing that needs to be noted here is that in the input of process 1 is the initial raw material input and the output of process 1 actually becomes the input of process 2. Similarly, the output of process 2 becomes the input for process 3 and the output of process 3 will be the final output of that entire production line. So this is how the process account would look like. So in an initial process, you will have opening, a work in progress, direct material, labor and overhead and so forth onto your input side. Onto the output, you would have the output of that process. So if this is the only process, the output will be the final output. But here there is a subsequent process. So the output is specified as output to process 2. So this becomes the input to process 2 accounts. You could see here output from process 1 will become the input of this process to account. Now, don't worry about these terms, normal loss, and abnormal gain. We will go through these terms when we go through the video in the latter stages. So the input to process account could be in following forms. It will be the direct raw material. So in our initial example, when we were talking about garments, it can be cloth, thread, all those would fall under the direct material. Conversion cost is a broader term that we use which refers to both labor cost and manufacturing overhead. So manufacturing overhead would involve electricity, certain amenities provided, all those fall under the manufacturing overheads. Output of previous processes. Now what needs to be stressed here is completed output. It's not partially done, it's completed output. So completed output from previous processes will also be input to the subsequent process. Finally, we have opening work in progress. So if you have any half done units, well, from the last time you ran the process, the next time you run the process, this work in progress will become the opening work in progress. This will also will be one of the inputs to the process. Output to the process account could be in the following 5 forms. It can be expected output, it can be abnormal loss, normal loss, it could be in the form of abnormal gain, or it can be in form of closing work in progress. Now what is this expected output? Expected output is the output that we expected, we anticipated during the normal operational conditions. Now these are the keywords that you need to use if you are going to define the word expected output. If you are running in the correct normal operational condition, in the correct efficiency levels, this is the output quantity that you can expect from the production. So how do you calculate the cost of this expected output? You have the total cost of inputs. So this will have direct material, direct labor and manufacturing overheads. And from this you will exclude any scrap value. If you earn any additional income from selling any loss units, the normal loss units, then you will exclude that. Now this value will then be divided by the expected output units. Now you might be wondering, will expected output be different than the total of input? Now what? Let's assume we used 1 meter of cloth to make a clothing item. That doesn't mean the clothing item will be using the entire 1 meter. There will be certain scrap materials. So these scrap materials are defined or is referred under the term normal loss. Now in any production you will have losses. Now these losses can be divided into two, normal loss and abnormal loss. Normal loss we also refer to as uncontrollable loss, expected loss. We already knew that this loss was going to happen. Because using a 1 meter cloth, if you are going to make a garment, there will be some scrap cloth left. This is known even if you work at the most efficient production environment, still these losses will be incurred. Another example is evaporation. If you are using any liquid, that could result, a part of it could evaporate, so that will fall under normal loss. And even in sample testing, that would also fall under normal loss. So when you are calculating expected output, you could see here total inputs in units is adjusted for the normal loss in units. So the residual will be the expected output. Now abnormal loss is a different situation. Abnormal loss is also defined or called as avoidable loss and controllable loss. Now this is a type of loss that the company has control over. They could have avoided if they had worked in an efficient environment. Now abnormal losses happen if you're operating in an inefficient environment. Okay, so whenever the actual loss of a production, actual loss of a process exceeds the normal loss, if the actual loss exceeds the normal loss, that incremental loss is known or is calculated to be the abnormal loss. We could either calculate it as that, or if the actual output is lesser than the expected output, again that difference is also calculated to be the abnormal loss. So when we go on in the next video, when we do the calculations, it will be clear for you all. There is also something called abnormal gain. In certain situation, even when you're operating at correct or optimal efficient levels, unexpectedly you might have received a higher output than expected output. Your actual loss would have been lesser than your normal loss. It's something abnormal, something unexpected. In that situation, that additional output received is recognized as the abnormal gain. Now, when we discuss process account in our subsequent videos, we are going to go through these three cases, these three scenarios. So case 1 is the most basic questions that we have, where we would see questions where there is no working progress involved. So these are relatively easier questions to tackle. But case 2 that we would see is where you would have some level of closing progress. In closing working progress, what happens? Because there is partially completed output left, you need to assess how much of raw material was used, how much of labor, how much of overhead was used for this partially completed output. So that involves an additional calculation. Finally, in case 3, we will see questions where you will come across both opening and closing work in progress. So when opening work in progress is involved in a scenario, you have to select what technique you are going to opt for. Is it first in, first out? Is it last in, first out? Or is it weighted average costing technique? So case 3 is mostly the advanced of the process costing. So we will be going through each of these cases individually. I hope this video was able to shed some light on this topic and provide you some fundamental knowledge on process accounting. Thank you for listening in. Subscribe to our channel Learning Business for more videos.